Welcome back to Fininsergy, your go-to channel for all things finance. If you're new here, don't forget to subscribe and hit the notification bell so you don't miss any of our financial tips and advice. Today, we're diving into an exciting topic, investing for beginners. If you've been thinking about starting to invest but don't know where to begin, this video is for you. Investing can seem overwhelming at first, but once you understand the basics, it's a powerful tool for growing your wealth over time. In this video, we'll break down everything you need to know to get started, whether you're looking to invest in stocks, bonds, or other assets. By the end, you'll have the knowledge and confidence to take your first steps toward becoming a successful investor. Let's get started. 1. Why you should invest. Before we dive into how to invest, let's talk about why investing is important. Building wealth. Investing allows your money to grow over time. Instead of keeping your savings in a regular savings account with low interest rates, investing helps your money earn a higher return, whether through stocks, bonds, or other investment vehicles. Beating inflation. Inflation is the gradual increase in prices over time, which reduces the purchasing power of your money. By investing, you can earn returns that outpace inflation, ensuring your money grows rather than loses value. Achieving financial goals. Whether your goal is to retire comfortably, buy a home, or build generational wealth, investing is one of the best ways to achieve your financial objectives. Passive income. Investing in dividend-paying stocks or bonds can provide you with passive income, meaning you'll make money without having to actively work for it. 2. Types of investments. Now that we understand why investing is important, let's take a look at some of the most common types of investments that beginners should consider. Stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a small share of that company. The value of the stock can go up or down, but over time, it has the potential to provide significant returns. Pros: high potential returns, dividends in some cases, and liquidity. You can buy or sell easily. Cons: volatile, meaning stock prices can fluctuate significantly in the short term. Bonds. Bonds are essentially loans you give to companies or governments. In exchange for your money, they pay you interest over a set period of time, and when the bond matures, you get your initial investment back. Pros: lower risk than stocks, reliable interest payments. Cons: lower returns than stocks, and inflation can erode the value of your bond's interest payments. Mutual funds and ETFs, exchange-traded funds. Mutual funds and ETFs are collections of stocks, bonds, or other assets. These are great for beginners because they allow you to diversify your investments, which reduces risk. Mutual funds. Actively managed by a fund manager who selects investments on your behalf. ETFs. Passively managed, typically following an index like the S&P 500, and can be traded like stocks. Real estate. Investing in real estate means buying properties, either to rent out or sell for profit. Real estate can provide both capital appreciation and passive income through rent. Pros: tangible asset, potential for consistent income, and tax benefits. Cons: requires large capital upfront, not as liquid as stocks or bonds. 3. How much should you invest? One of the most common questions beginners have is, how much should I invest? Start small. If you're new to investing, it's important to start small. Don't put all your money into the market at once. Begin by investing a percentage of your income that you're comfortable with, even if it's just $50 or $100 per month. The key is to get started. Set clear goals. Before you invest, think about your financial goals. Are you investing for retirement? For a down payment on a house? Or to build wealth for the future? Your investment strategy may differ based on your timeline and objectives. Emergency fund first. Make sure you have an emergency fund in place before you start investing. Ideally, this should be enough to cover 3 to 6 months of living expenses. Having an emergency fund will give you peace of mind and prevent you from needing to sell your investments in times of financial crisis. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market's performance. This helps you avoid trying to time the market and smooths out the effects of volatility. 4. How to get started. Now that you know the basics, let's go over how to get started with investing. Choose a brokerage account. To buy stocks, bonds, or mutual funds, you need a brokerage account. There are many platforms available, including Robinhood, Fidelity, and Charles Schwab. When choosing a broker, look for low fees, a user-friendly interface, and good customer service. Start with index funds or ETFs. For beginners, index funds and ETFs are great options. These funds track the performance of a market index, like the S&P 500, and provide broad diversification with a single investment. Invest for the long term. Investing is not a get-rich-quick strategy. It's a long-term game. Stay patient, stay disciplined, and allow your investments to grow over time. Reinvest your earnings. Reinvesting the returns from your investments can help you compound your wealth. For example, if you earn dividends from stocks, consider reinvesting them rather than taking them as cash. Over time, this will significantly increase the value of your portfolio. 5. Common mistakes to avoid. While investing can be a rewarding way to grow your wealth, beginners often make common mistakes. Here's what to watch out for. Trying to time the market. Trying to predict short-term movements in the market is a losing game. Instead, focus on long-term goals and stay consistent with your investments. Ignoring fees. High fees can eat into your returns over time. Make sure you understand the fees associated with your investments, whether they're brokerage fees, management fees, or fund expense ratios. Lack of diversification. Don't put all your money into one stock or sector. Diversify across different asset classes to reduce risk and improve your long-term returns. And there you have it, a step-by-step guide to investing for beginners. Whether you're just starting or looking to refine your approach, remember that investing is a long-term strategy. The key to success is starting early, staying consistent, and focusing on your goals. If you found this video helpful, be sure to like, subscribe, and share it with your friends. Let us know in the comments what kind of investing topics you'd like us to cover next. Thanks for watching, and I'll see you in the next video.